If you've not signed up for my free 5-day challenge, please check the description box and click the link, sign up to learn all the tools that I've developed to overcome the anxiety and the frustration that develops in trading and blocks you from maximizing your performance. It's really important. The psychology of trading is far more important than technical analysis. You can be the best technical analyst on the planet, but if you don't understand the psychology of trading and how to control your emotions, you're never going to maximize your profits. I've been asked by a lot of my subscribers and also my social media followers to give a full breakdown of a chart right from the very start of the process, right through to identifying low risk trades, because I think on my YouTube channel I tend to focus on the slightly shorter term charts where I've already got a lot of my levels and my trend lines and my fibs and my moving averages on there, and then it's only at that stage that I'm identifying low risk trades. So if you want to see exactly from a completely clean chart on a long time frame how I put all of my tools together and then go into shorter and shorter time frames to identify these low risk trades, and then have all the levels laid out in front of me for the future, then watch this video. It's only 20 minutes long. I cover the Euro USD and the Pound USD, and if you watch, you're going to get some excellent long-term trading levels as well. So I hope you like the video. Please like and subscribe. If you do so, the likes really help me. I'll put trend lines on there here like this, just to clearly show me which direction the market is trending, and I will leave these on. Here we go. Where are we? Yeah, I will leave these on because these are long-term trend lines, which we might need in the future, even though the price is nowhere near these trend lines now. If, for example, Euro US dollar got up to around the 116 area, which is the upper trend line, which is also coinciding with the green, not far off anyway, the green, which is the 500-week moving average. This, for me, I can immediately see that this would be a good sell area. I would definitely be trying a short position if we got up there. The next thing I will do is put some Fibonacci levels on there. I love these. They work really well. I don't really know why. I don't know whether it's a self-fulfilling sort of tool that everyone just uses, so everyone ends up putting their orders in at the same level, but they do work. And Fibonacci's are so simple. I literally just take the swing high, I put it at the swing low, and that gives me levels at which I know I should be paying attention to. Now, quite interestingly, the 23.6% fib is at 110.69 on this chart. We didn't get up that much higher. We got up to about 112.75. So we did overrun it by almost 200 pips. But you can see on the grand scale of things, that's a small overrun probably within a margin of error. We hit the 200-week moving average and we turned down. So I'm wondering if we are going to start, or if we've already started to resume the bear trend. It does look to me like we probably have for the euro. So this is the big picture, right? Bear trend, hit long-term resistance, turned around, looks like we're resuming the bear trend. We are testing on the downside the 100-week moving average, the 50-week moving average, so we are finding some support there. That's pretty much all I need to take from the weekly chart, but that has now given me a good outline of what's going on. And now I'm going to go down into the daily chart. So already I'm thinking, okay, this is looking quite negative for the euro, but I'm going to go into the daily chart and I'm just going to isolate that up move that we had from, I think that was September of last year. So this is the data for the last 1 year, in fact. And then I'm going to put some more Fibonacci levels on there. So very simple. Take the swing low down here, take it up to the swing high up here. Then I've got a little bit of a roadmap perhaps for Fibonacci levels here as well. Now you can see we've kind of paused here around the 23.6% fib, but it looks like we're resuming that move to the downside. On the daily chart, we have broken, you can see how the 100-day moving average acted as good support there. Then we broke below it, but headed above it. And then the 100-day moving average acted as good support here again. That was around the beginning of July. And again, 100 and the 50-day moving averages, they were really good support just above the 23.6% fib level. Now we've broken down. So again, this is also starting to confirm to me from a directional perspective that the euro is perhaps starting a downtrend. We bounced off the 200-day moving average. We were caught by the 100, the blue line, and the 50, and we sank. Now we've sunk below the 200-day moving average. You can see how this is developing into something of a bear trend in the short term ever since the 18th of July. So we're getting on for 2 months bear trend. Some people would argue this is a correction in the bull trend. I'm starting to think that this is a resumption of the longer term bear trend. Now, as long as we hold below sort of 1870, 1920, I'm going to remain. It's going to indicate to me that this market is heading down. We've got a little bit oversold on the slow stochastics on the bottom there. Now, this is something to remember with oscillators. I don't know if you use oscillators. When I first started trading, or first started doing technical analysis, I thought, wow, these oscillators are just magic. As soon as it gets into overbought territory, you just sell it and it'll go down. But it doesn't quite work like that. They can be useful as a tool, and I do use them, and I do keep an eye on them, but I never base a trade solely on the slow stochastic or the RSI or whatever it is, whatever oscillator you might have at the bottom of your screen. I don't solely base a trade on it. Now, this is the general rule for me. When you are in a bull trend, as this market has been for about a year, and you're looking for buying opportunities, for example, this correction here, I don't know whether that was a fib level or whatever, but it certainly found support at the 100-day moving average. And probably I should have a trend line on there as well, or I would have had a trend line on there. Look, there's the bottom. I would have taken that. Actually, yeah, no, I'm kind of, that would probably be where the trend line was. So it didn't actually quite touch the trend line, to be fair. But anyway, you're looking at this, you're thinking, let's say for argument's sake, we thought, okay, this looks like a strong bull trend. I want to be on this. And you can see that we did bounce off the oversold level. But the thing, we got oversold, critically oversold here. This is the point where we really got oversold. Then the market kind of moved sideways. We did dip a little bit, but can you see how we got this divergence here? You can probably put this is what we call divergence. So again, I wouldn't use this to base a trade, but I'm just going to show you how it works in case you're not aware. We're in a bull trend. Now I'm going to start paying attention to the fact that we're getting oversold, and then we're seeing a divergence here. So this low is higher than the previous low, whereas the price is making a new low below the previous low. So you can see that this is called a bullish divergence, and it indicates that the market might turn around and resume this bull trend. So that's a nice little indicator. Again, I don't base my trades solely on that. Now, because we're in a bull trend, you need to forget about when the market gets overbought. You can see we stayed overbought for a significant period of time here, longer than we were oversold, for example. And that happens in a bull trend. We can stay overbought. We can get overbought very quickly in a bull trend, and we can stay overbought for a long period of time in a bull trend. So just when you're looking at your oscillators, just see how long have we spent in overbought territory as compared to oversold territory in the past. And this is probably a good indication of what kind of trend we're in at the moment. We bounced very quickly from oversold territory here, very quickly here. Didn't even make it to oversold territory on that dip. Here we bounced very quickly as well. Then we got a divergence. You see what I'm saying? Here we moved quite quickly. We turned around quite quickly. And then we had these long periods when we were stuck in overbought territory. So if we had started selling there, we would have done really badly. I'm going to show you how it works in reverse when we're in a bear trend in a minute. Okay, and it's interesting to note now that we're not spending much time in overbought territory, anywhere above this blue dotted line, above the 80. We're not spending much time there. As soon as we're getting overbought, we're turning down. Now we're starting to spend more time in oversold readings. So again, that's starting to indicate to me, hang on a sec, you know, we're not bouncing when we get oversold. So this is another reason why I'm starting to think the euro is entering into is resuming that longer term bear trend. And I'm just going to now scroll back and show you again. Hopefully this will all back up what I'm saying. We'll see. So yeah, you can see that in this bear trend, whoops, what am I doing here? Okay, well, that's enough. Just taking from this bear trend here, you can see that we didn't spend long in overbought territory. As soon as we got overbought, we turned around pretty quickly and reversed. These two peaks didn't even quite make it above the 80 line. And it wasn't until the market had reversed that we started spending longer periods of time in the overbought areas. So, but on the downside, it was the oversold areas that we were spending more time, and that was because we were in a bear trend. Anyway, I probably said enough on that, but hopefully that makes sense to you. Let me just read this comment. Depends on what trader you are, Jason, if scalping or mainly trading in LTO. Yeah, okay, that's absolutely true. I'm showing you how I do it. You might do it completely differently. You might trade completely differently to me. That's absolutely fine. Everyone has a different style of trading, and what I do may not work for you at all. I perfectly accept that. Right. Now I'm going to go down to the 4-hour chart and actually really examine what I believe is the beginning of this bear trend. So I'm going to put trend lines on here. Okay, that'll do. Thank you, Sue. I'm glad that was useful. Sometimes I do come out with interesting things. Right, another phone ring. Okay, now I've got this trend line here. There we go. So you can see I've done the same kind of thing here. I've done the same kind of thing here from the peak, 18th of July. So again, just to repeat, we're looking at something like 2 months in this bear trend on the 4-hour chart. So I'm just going down into shorter and shorter time frames and isolating the trends. So this for me is now the prevailing trend because I'm a swing trader. I focus on the 4-hour chart. This is the trend that I find that I will focus on. So for me, I'm now in sell the rallies mode. I think that the market has resumed a longer term bear trend. The market is in a 2-month bear trend. The 2-month trend is enough for me. I'm not bothered that we've rallied in the last week. That's not something I'm too focused on. Again, I put my Fibonacci levels on there from the swing high to the swing low. I'm actually going to put a second set of fibs on as well. So I'm building up more and more lines on this. You see that this 61.8% here, I don't know if you can see that on your screen. This is the 61.8% fib. And this is really common, that you have a little swing high up here in a bear trend and then boom, we accelerate to the downside. You'll be amazed at how often you see that. And then I take my second set of fibs and I put them on there like that. And it just gives me another set of trading levels. And this is really nice actually here. These have lined up really beautifully. I'm going to open it out and try and hope that you can see a bit more clearly. So this is the kind of area now that I'm focused on if I'm looking to trade. So say for today, you can see that the 23.6% fib, this is the second set of fibs that I just put on there. It ties in really nicely with this swing low down here, swing low here, swing low here. So it's reinforcing to me that the 107.70, 107, I don't know, 107.65, 107.75 area should be a good resistance level on the bounce. Now, it already was. The high of this candle is 107.50. So 107.52, I think was the exact reading. Was it 107.52? There you go. So we missed it by about 20 pips. So the sellers clearly, someone else thinks that this is a good resistance level. You can see the sellers came in on the 4-hour chart. Look at that candle. Long upper wick, small red body. Now, what's this telling me? We could just stay in this range. We could just range from 106, 80, 90 up to 107, sort of 55, 75. But and we are at the moment, we are establishing this sort of range. My theory would be that this is probably a bear flag. So this would be the trend lines that I would be drawing on here. You can see I'm really like drilling down now into small detail. So for me, this is a bear flag in a bear trend. Let me scale this again. There we go. Can you see that down here? This just looks like a bear flag to me. So this is the picture I'm building. We are resuming the longer term bear trend. That bull trend that we had from September 22 up to July of this year was just a correction in the bull trend. And then now we're forming a bear flag. So that would indicate to me we will probably break to the downside. Once we break through this trend line, that will be my sell signal. Once we break below the previous low, that will be another sell signal. If we get up to, I'm going to blow this up again. If we get up to the trend line and the 23.6% fib, you can see they're kind of intersecting there at around that 107.70, 107.80 area. As I said, I'd be getting into a short position. So you can trade the flat. I wouldn't be too keen on buying into a long at the lower trend line, because I think that will break eventually, because it's a bear flag. I think we are in a bear trend, and my rule is that I don't trade against the trend. So I'd be very happy selling into a short up here, taking the profit down there, and then wait to see if we break to the downside. If we don't and we bounce off it again and we come up here, I'll sell it again. That would be my euro strategy, dead simple. So now if we break higher, if we break, you see how the blue 100 period moving average on the 4-hour chart is coming down to meet that trend line as well. So that will add weight to that resistance level by the time if we get there. Say for example, today we have a weaker than expected CPI number. The market jumps from around 107.35 up to 107.75. By the time we get there, which I believe is in about 4 hours, we might have that 100-hour. Well, no, it won't have come down that far. It'll have dropped slightly more in 4 hours time. But to me, that is looking like a good resistance level. So if you're trading the CPI today and then and we do bounce and you think we've probably bounced far enough, just bear that level in mind. I'm not saying it'll definitely hold. I don't know what the CPI number will be, but that to me looks like a good resistance level. I can say that for sure. If we keep bouncing, we have another trend line. Can you see this other trend line? Maybe I've got too many lines on there, but this is another trend line, that the first one that I put on. Now look how beautifully that trend line matches the 23.6% fib at 108.24, the second fib that I just put on at 108.29. So that sort of 108.20, 108.30 area looks like the second big resistance level of the day. So there you go. If we get a bounce in the euro versus US dollar, my theory is that those are the levels that would be worth trading. Now I go down to I even go down to the 1 hour chart. There we go. We're sort of fumbling around with these moving averages. The moving averages are starting to flatline on the 1 hour chart, because basically we've been going sideways since sort of 5th of November. You can see, sorry, 5th of September, sorry. You can see that we've basically just been going sideways. I've got my trend lines on showing the bear flag, and that is a consolidation pattern. The bear flag is actually a continuation pattern, meaning that we should break to the downside and continue and resume the bear trend. So a bear flag is actually counted as not only a consolidation pattern, but also a continuation pattern. I'll do dollar yen next. I'm just going to quickly run through cable. So you can see cable is in a bear trend. We've had a really good bounce up from that Liz Truss debacle. But again, I think it's just a bounce in a bear trend. I'm even going to go to the monthly chart just to make sure I get my fib levels right. I mean, go to the monthly chart. Look, there is no doubt the cable's in a bear trend. I actually don't normally go to the monthly chart, if I'm honest with you. But out of interest, I am just going to throw some fib levels on there. And look at that. Now look, this is why you have to go long term with your charts. This, I believe, is 2000 yeah, that will be the beginning of the global financial crisis, I think, when the markets collapsed. Now look, I didn't know this, But I put my fib levels on from that big swing high. You can see the market rallied up significantly to that swing high, and we've dumped ever since. And look, 23.6% fib. I'm on the monthly chart, and it's showing the 23.6% fib at 29.07. Where's my crosshairs? Where did we get up to? We got up to 131.41. So okay, we overran it by 200 pips, but you can see on the monthly chart that's just a margin of error. On the month, we didn't close above that fib level. The 50-month moving average and the 100-month moving average also offering resistance there. So imagine if you were looking at that and thinking, right, we've just recovered by 2,600 pips, and I think that's a good sell. You'd already be looking at a 500 pip profit, and we've barely even come back from that level. So if you're a swing trader, this was an absolutely stonking trading opportunity. You could have had a maybe 300 or 400 pip stop, and you could be looking at maybe 1,000 pips on the downside. That would only take you down to around 119 down here, and that wouldn't even be that much. That would just be here. I mean, you could easily have 2,000 pips on that trade if you're willing to run it long enough. So this is why you've got to look at longer term charts. You've got to be aware. If you were thinking, oh, we're in a lovely bull trend, I'm just going to keep buying this every time it goes down, because on my daily chart, we're in a nice bull trend. There we go. You could be looking at that and thinking, yeah, nice bull trend. I'm going to keep buying this every time we go down. And you would not be aware that this 23.6% level and all the moving averages on the monthly chart were telling you to sell this like crazy. Okay, so then we go down to the weekly chart. Bang, here we go. Again, nice resistance from the 200-week moving average, the 100-week moving average. We're now dipping down there. I'm just going to race to the daily chart. We know we're in a bear trend. What's happening on the daily chart? I'll put some fibs on here as well. There we go. Okay, what's going on now? Look, again, this is just lining up so nicely. You'd think I had this pre-planned, and I really didn't. But look how I know what cable's been doing, but just look how beautifully that's working. The 23% fib of that whole recovery that we've had since September of last year has now come down to the 23.6% fib. We're holding that and the 200-day moving average. So we are at a very critical point. We're at a really good support level. Do we bounce off there? And this would probably be worth. It would be worth trying a long position again. This is the whole point of why we're traders, is to find these kind of opportunities. And then if we break below the 200-day moving average, we quickly switch into a short position, because we're probably going to head down towards sort of 121.00, 120.50 area. So you see how the charts just give us so much information. You can see that we've broken below the 50-day moving average became a good resistance level. We eventually broke below the 100. So if we do bounce off here, the question would be, let's say you want to take a long position now. Let's say you really fancy a gamble. You're going to gamble that the CPI number is going to come out weak, and you're going to buy cable. You're going to buy the pound versus the dollar. Because if anything's going to benefit from a weaker dollar, it looks like the pound will be it, judging by the technicals at least. And we could bounce up to the 100-day moving average, which is around 126.5. So that's a decent risk reward. If we're buying it now at 124.74, we could be looking at 150 pip profit on the upside with a relatively small bounce, and we could have a risk. Let's say we could put a stop in at we could have, just to make the numbers easy, we could have an 80 pip stop for 150 pip profit. That's an almost 2-to-1 risk reward ratio. Again, that's what we're in the market for, to get these kind of trades. We're oversold on the daily chart as well. And we at this stage, this is just a correction in the short-term bull trend. So I could certainly argue that buying cable here is worth taking the risk, as long as you're prepared to quickly switch it to a short position on a breakdown, because that's, again, going to be a potential 300 pip winner if we do break down. So you've got to be prepared to be nimble.